All right. Is everybody caffeinated? We got the music going here to try to get everybody pumped up because we're going to be talking about tax and accounting. Yoo-hoo! All right. So in the effort to keep things really going and keep it exciting and keep things on a really cool level, we want to start off with a quick disclaimer, which is everything that we talk about here is not considered advice. Is this true? We have a lawyer here to tell us exactly what the disclaimer is. But essentially, this is just essentially our thoughts and comments about what we're observing in the marketplace right now. And of course, as you go down the road and doing your thing, make sure that you do seek proper counsel, that you do seek proper advice and pay for it. So with that, I want to introduce our panel. And I guess each of us can give a quick 1 minute, 2 minute, what we're all about. And probably a good question would be how we got into this, because everybody's got a backstory.
Yeah.
So what's the backstory?
All right. Okay, well, I'll start. I'm Jarick Poulson, and I'm here out of Salt Lake City. I'm with Deloitte Tax. And to start off with how I got into this, I've been in tax for about 15 years, and this has been the most exciting time for a tax professional, in my opinion, to be in the tax profession. And you've got smart people that are developing incredible technologies, and we get to figure out what to do with it all from a tax perspective. And so just in the last 2 years since I've really been involved, we've been addressing issues around compensation, international tax, migrating IP, all the issues that come around with ICOs is a big thing, mining, like just issues that you haven't dealt with before in the tax profession. And it's been super exciting. I'm fortunate to be part of a team where we have now over 300 professionals that are involved in our blockchain community and are dealing with these types of issues with specific to tax. And then also a team of consultants within Deloitte that we work with and collaborating and developing solutions, working with companies, and also on our advisory audit side. So we do a lot of work together, and it's just a lot of fun. And so glad to be here and enjoy to be part of the discussion today.
And to keep it really interesting, we have both Deloitte and E&Y in the same room, sitting side by side. So this is going to be a really interesting conversation today. So David?
It may get violent. We'll see. No, nice to meet all of you. I'm David Byrd with Ernst & Young. And, you usually don't get this much interest in tax and accounting. It's just amazing. No, I just echo your comments. Jarick, right? Yeah, that I sit in the financial services audit practice. And my clients for years have been hedge funds, private equity firms, VCs. And as they've begun to contemplate investing in these crypto assets, just to pick a general term, I started to get my head around this stuff. I also, just to kind of create the backstory, had good friends in grad school that ended up working in the industry. I also have a PhD in cognitive science before I came to EY. I can tell you about that story some other time, but it certainly makes it interesting. And so for a number of years now, we've tried to figure out how would you audit cryptocurrency and related, assets. And to do that, you really need to get the accounting right. And which framework? Is it GAAP? Is it IFRS? So all sorts of things going on. Happy to tell you more, but that's my story for now.
Hi, everybody. My name is Adam Juratovac, and I'm an attorney at Juratovac Law in Palo Alto, California. So I started getting into cryptocurrencies and, more importantly, blockchain companies within the last year. I'm a corporate attorney by practice, and I just started getting clients who wanted to pay me in cryptocurrencies. So I just got my first client pay me in Litecoin. And right after that, I saw a whole market of individuals, and particularly more entrepreneurs who were getting in that space, and they had their funding too. They're predominantly self-funded, which, they had problems that they needed solutions for, and then that's what I provided to them. So that just kept on growing until I started taking on more blockchain companies, helping them do their best practices for their white papers. And granted, this was in late 2017, early 2018, so a lot of things have changed since then. I continued that education with trips to Southeast Asia, met with the SEC commissioner last month, and then so now I'm fully involved within the blockchain world.
Great. And so my name is John Narrowway. I've been in the technology scene for many, many years. I remember when the internet made noise when you connected to it. And right through to the last couple of years, my job has essentially turned into being a futurist. I work with governments and companies looking at the future trends and looking at which technologies 3 to 5 years from now are going to have commercial viability, and specifically with the government of Bermuda, working with them in determining the rules and regulations that would attract companies in various different industries. And as we were looking at some pretty hard tech industries, we realized that the funding space was shifting in the way that these hard tech companies would raise capital. And that's essentially how we came across blockchain a few years back. And specifically crypto in the ICO space. It's an incredibly fast-moving category, so it's really hard to stay up on it. Anybody who says they're an expert in this space, I think is a liar, because every day you're learning something completely new. And interestingly enough, even from a regulatory standpoint, a tax accounting standpoint, opinion seems to shift a little bit also as well, because the landscape is still really being defined. The topography is still being defined. So it's an incredibly exciting space. So we'll kick off this conversation with, I guess, a disclaimer. We have no prepared questions. We're not doing the Q&A type thing. We wanted to actually just make this a nice casual conversation so that it is, not contrived, and it's actually, really a good in-depth conversation. Also, if you do have questions, we want to leave a bit of time for Q&A at the end. So we're going to go for about maybe 20, 25 minutes, and then allow you to ask some, the toughest questions you possibly can while you have us for free advice. Well, not advice, but free opinion. No, not opinion, free something, free observation. So I guess the first question is the landscape of tax. Like, if I am an American doing an ICO, am I in for a world of hurt?
Well, yes. But less hurt than you would have been after. Actually, so it's interesting because you look at an ICO, and as we all know, the IRS views cryptocurrency that come out. The one notice that they've published is that it's property, but that was based on cryptocurrency, and a lot has changed since they issued that notice. And so the very first thing you have to look at is, you have to look really closely at what your token is. What is it used for? The characteristics of that token can change the tax result. And so in one instance, yeah, you'd be taxed in certain situations, 21% on your ICO raise. That's the current federal rate plus state. There are ways you can do some international planning if you have an international business, and it makes sense for you to move that direction. But it can be hard, and takes a lot of planning, a lot of effort to get there. It's not as simple as just setting up an entity in Bermuda, which is a great place to go, and saying, hey, we're gonna do our ICO from here and pay less tax. U.S. rules aren't that easy. It takes a lot of planning to do something right, and tax usually follows business. You don't just do something only for tax reasons. You need to have business purpose behind it and some substance, and there are definitely ways to mitigate or decrease the tax impact, which is everyone. Tax is meant to be fair, but also no one should pay more than their fair share. And so appropriate tax planning is important, and so expensive, but it can be. There's some good planning opportunities to how to minimize that impact. I guess I was saying short.
I'm curious. One thing that we've observed that complicates this is that tax issues around securities have historically well-defined, either safe haven or something like that, but you just don't have that yet for cryptocurrency, right?
Right, and you bring up a really important point, because when something is treated as a security for securities law, that doesn't mean it's necessarily a security for tax. There's a different construct of law. You could have a security token that for tax is a piece of property, or that same security token could be equity. If it's equity, then it's not tax. But the security definition of that token doesn't always correlate to the tax definition of that token.
And just to complicate that, because last week, the SEC, Ether's not a security, great, right? what is a security? You have the SEC's precedent, right, the Howey test, and you looked at those considerations. And then you have IRS, for example, in this framework, that definition, which is not the same necessarily definition as, and so too in accounting, right, is that the U.S. GAAP definition of a security is not the same necessarily as tax or the SEC's definition, right? And so it's not like they're so wildly different that you see these great, but there are important nuances to spell out there.
Even from a tax and accounting difference, I mean, you're going to treat it one way, and I might treat it a different way from tax. You know, you might call it deferred revenue, and I'm going to call it a sale of property at the time of sale. Adam, I'll bet you have some thoughts on.
Yeah, I just want, and that's all dependent on what you do with the rest of the business, right? So when you look at the overall business and their revenue streams, you're going to decide the best route for them. And I think that's what, you know, they're all doing for the big businesses, but as my business, as we started, like on a smaller scale, much smaller scale, when we started accepting cryptocurrencies as payment for services, we had to process all of that out too. So my background is in public accounting, and my master's in accountancy with a tax emphasis. So when I started receiving those, the first thing I knew is that there's going to be an auditor doing a walkthrough of my business, which means that an auditor is going to come into your business, examine all of the controls you have in place for the procedures of your business, of getting money, transferring money, getting checks, pretty much everything you need to run a business. So I had to make sure that all of those were itemized out and lined out 1 through 10 with the strengths, weaknesses, and also the other controls. It's not that hard to do on a small scale, especially when you have a services-based business. But when you start having a business that sells widgets or sells goods, then all of a sudden you need to start doing the traditional modes of accounting for your business expenses. And those are all the cost of goods sold as well. I'm sure these guys can tell you all about that, especially when you want to scale up and your business goes international and decentralized like it should be.
Sure, I mean, just to take one example from accounting, which is such a challenge, I mean, we wish now that, for instance, in the IRS, that it wasn't deemed property and you couldn't have and that you could have a like kind or a 1031 exchange. That would make things a lot easier, right? Or some sort of safe haven. So too in accounting, because if you look at this, you know, there's no guidance right now. And so if you try to look at the ways that companies are transacting, what is it? Can you just simply fair value it as you might, you know, a security or something like that? I mean, if you are an investment company and there's specialized accounting for that, then there might be a simpler path to the fair value of that. But if not, then you might be saddled with a sort of indefinite-lived intangible asset, right? Where what's the accounting treatment for that? Well, it's cost with impairment, and so that doesn't map on to the economics very well.
What does cost and impairment mean?
It means that, you know, if you say, I mean, you're a company, you acquire some Bitcoin or Ether on exchange. How much did it cost you? So you mark that, right? And then as you've seen the volatile market in the last year, right? You've seen amazing you know, increases in value. But so can you just mark it up, right? That's sort of your gain, unrealized or realized if you sold it. No, if you don't have a path to fair value, right? Instead, it means you're marking it at that much smaller, depending on when you got in, cost, and then possibly impaired. But you can't mark it up, and it just doesn't, right, track. So of course, I mean, the standard setters are aware of this, and you know, many of us work with them to try to build out a better informed, you know, guidance, but it's just not there yet. Right?
I mean, there's so many questions. We're dealing in a completely new world when it comes to these types of transactions. I mean, you think of, we have been dealing with fiat type currency, and all the tax laws, they're all based on this type of transaction, right? And in a way, we're stepping back 1,000 years and saying, we're going to start trading property for property, you know, carrots for potatoes, but actually one piece of digital property for another piece of digital property or whatever it is. And so it's taking the laws that were written for fiat-type transactions, and now they're barter exchanges, property for property, and it changes everything.
Yeah, and that's a little bit of what we We contemplate. So Bermuda, just for everybody's education, Bermuda is the only country in the world to have laws on the books. We have 2 sets of laws that we've passed in the last couple of weeks around digital assets and doing an ICO. So we are crypto friendly to a great degree. Our first law around ICOs basically makes it a restricted activity, but what that means is that if you're doing an ICO, we actually state what your minimum criteria is and full disclosure around your beneficial ownership and a whole bunch of things, which puts you actually in a great position to say, we're actually doing it properly. And that creates great investor protection and what have you. The other side is the digital assets, and that's what I want to talk about, which is, part of what we did is we actually have this common belief, the religion, as it were, that we believe all assets will be tokenized, all property will be tokenized within 5 to 10 years. So the idea was, let's get some laws on the books today that contemplates that and start creating that regulatory framework that says, look, we think this is going to happen. And then we will actually, be pretty long on the tooth when this actually becomes a real thing. And it's happening much faster than I think anybody realizes. There's a lot of experimentation. This feels like the greatest human experiment ever. And we're all the guinea pigs.
What you're trying to do then in Bermuda is very much appreciated, and this is not choreographed, I swear, because in addition to accounting, like I mentioned, I sit in audit, and a lot of companies in the space very much want an audit, right? They want to show that they're operating legitimately and in compliance, and they know that they can grow and instill confidence in their investors and their clients, right? If you're rubber stamped by someone with a good reputation, and so, but it's challenging when you come in and take a look. I'm saying from an auditor point of view at that internal control framework, right? Because what we're seeing is very mature companies doing surprisingly immature things when it comes to cryptocurrency. If you have operations, and you're seeking an audit, even if you're not seeking an audit, you should have robust internal controls, simple things, right? That you can make sure that you're safeguarding assets, who has access to the private keys, and we can get a lot of detail here. So usually the companies we're seeing aren't quite ready for an audit. Not even mentioning whether they're public companies. What they need is some guidance as to how to implement these internal controls. So take a good hard look at that.
Absolutely. I mean, you have a lot of new companies that are dealing with issues that historically aren't dealt with until you're a very mature company. And it puts a lot of strain, I think, on some of those initial costs and startup costs that historically companies haven't needed.
I think it's going to get to the point within a few months, and you can mark my words on this. If you do not have a chief compliance officer on your team, you're not going to make it. Like, if you're not thinking compliance on a daily basis, you're not going to make it. Like, it's just the world is going to close in around you, and you're going to just get snuffed out. I think that's kind of just where it's going to be really, really quickly, because it's the burden of that is something that people really have to come to terms with really quickly and develop systems. And the beautiful thing is, this is technology that actually is, you can actually program your way out of some of these problems. And I think compliance is a great way where you can actually do a lot of this work, even through smart contract type technologies, right? So
sure, and to fill that need, we're seeing a number of compliance officers and others that have operated in the traditional finance world, outside of crypto, that are so interested in, like we said, tax has never been so interesting. Accounting's never been so. Compliance is quite interesting. Now, granted, as a compliance officer, you don't really seek risk, right? But there are some tremendous opportunities for companies in the space that are doing quite well. You might say, well, I'm a startup. How do I afford some of this stuff? Well, absolutely. You, of course, have to keep that in mind. But, some of the companies...
hire a compliance officer. Don't buy a Lamborghini. Should be the rule, right?
That should be a lesson learned.
Yeah, lessons learned. And I think it's interesting. Like, all of a sudden, like, tax, accounting, compliance, KYC, AML, like, all these things that we kind of have been... or even regulation they all seem like dirty words to progress and to innovation. But really, in this world... And when you think about we're replumbing the financial world, it's actually that it's so incredibly important that we actually contemplate that it is part of our day-to-day thinking, that it is centric to every conversation that we have as we go forward. Because it becomes, if you will, the underpinning structures as we replumb this financial world.
You know, especially when you're looking at tax consequences for your actions of the business or your individual actions. How many people here have heard tax advice about their individual Bitcoin or other cryptocurrencies on Facebook? Raise your hand. All right, I know everyone has, right? Raise your hand if some of those people are telling you to use LIFO, which means last in, first out. The last Bitcoin you purchased is the first one that gets removed from your purse. So currently, what a lot of my friends who are CPAs for high wealth individuals, and I take on crypto rich individuals as well, is we use the same guidance that the AICPA has been given out, which is you need to do specific ID for individuals, right? You need to be able to track each transaction. That way you're able to tell which Bitcoin left, what you purchased it at, and then what you converted it to, and that will be your recognized gain. So if you're unable to specific ID those transactions, then you should use FIFO, which is first in, first out, which is the least advantageous for individuals. So I know currently there's no guidance, there's no set rules on it yet, but there are people providing guidance, and then that's how, you guys probably know more about this. Who does every single CPA look for advice, aside from the AICPA? What is the biggest individual tax service provider in your world? Like a Charles Schwab, like one of those big ones. That's the advice they're giving to all of their accountants. So all the accountants at a local level, which is going to be in all the little regions around all the states in the US, they're using specific ID, and if they're unable to do that, they're using FIFO, which if you want to hire a CPA to do specific ID for each of your transactions, which you've only gained 2 cents each time, it's going to cost you a lot more money to hire that CPA than to just use FIFO from the get-go. So just think about that as a personal level, right? No one really knew what to use in this room. And then when you give it to your CPA, they're still researching on the internet and researching through all of the sources that they have to figure out what they should do based on previous experiences. That's a similar world that we're in right now. As me as an attorney, all I could use is best practices for what I've worked with my clients in the previous industries that I've been in. And, you know, following trends, that's always a big thing. So one of the trends right now is getting your company to be auditable at a very early stage. That means incorporating these guys way earlier than you normally would in a traditional startup. And that does cost money. So what a lot of the new blockchain companies who plan on having an ICO should do is they should incorporate some of those percentages of tokens and actually get seed funding from the traditional sense to be able to pay for tax planning.
And it's actually, so in our Bermuda laws, we actually, in our Digital Assets Business Act, actually require an audit, like a systems audit, and then we're moving to the next stage eventually, which will be a technology audit has to be completed as well, so that there is, if you're doing custody, that, you've got full security around your wallet's infrastructure, whatever that looks like at that point in time. But
yeah, and it's tricky, right? Because so many companies want an audit because they know they can, engender that support in their network, but they're not necessarily available. Depending on what you do, are the auditors ready? Are the big four, for instance, or even some of the regional firms, do they have built out crypto audit practices? I could tell you that not all of them do. And yeah, like your comment about they'd be lying if they told you they were an expert. You get some of that, right? Is that
I guess my thing, I think, is perhaps the advice or guidance that you're given, you have to understand that it has a time limit. Like, it's good today, and it's probably good for a couple of weeks, but at some point, you're going to have to refresh that. And you have to contemplate the cost for that in your business models, in your projections, in your run rates. That, you can't just plot out flatline, I'm going to spend $20,000 a month on accounting and legal advice.
Right. No.
You're going to have some pretty big chunky bits, and you probably want to contemplate that going forward on a frequent basis.
You do need to, and the reason why it's a good idea to start having that conversation with, maybe they're not your current auditors, but they're willing to consider your case, and they might offer you some advice around best practices, is that not every environment where you as a company or as an individual hold cryptocurrency is going to be equally auditable, right? I mean, where is it? Is it self-custodied? What are the controls around that? Who has access to that? Is it held on exchange? Who is that? Are they regulated? Do they get audited? Do they commingle those assets with their own, that also complicates the accounting. It's not clear that if you hold cryptocurrency at an exchange, you can actually list on your balance sheet, Bitcoin or cryptocurrency or crypto assets, right? It could be that you're entitled to some sort of a futures or forward contract, right? You've given them US dollar, right? And so it's important to have those conversations now. Auditors might want to participate in a key ceremony, right? To sort of lock down those internal controls. I see, wow, no one has access, no individual has access to private keys. Here are the sort of ways it's being custodied and backed up. This is the way that a third party could gain some evidence that your investments exist, right? Are completely stated, are properly valued. We've had to invest significantly, as I'm sure you have too, in our own technology to audit this stuff, right? I mean, how do you know that a certain address has Bitcoin or Ether to it? Well, you go to Block Explorer and you type in the address and there it is. Well, who's running that site? Oh, well, maybe you do a few, so you can triangulate. Well, how do you know they're independent from each other, right? And so we have, for each of the currencies in scope that we've seen or contemplated, have built basically a blockchain analyzer, which is a Block Explorer for our own use, that we can then obtain a key bit of audit evidence that we don't have to rely on some unknown third party. That's just an example. That doesn't somehow get you comfortable with everything. It's part of an overall body of evidence. But just as an example, right? So start talking to people that are in the field if you would like that, because you need time to sort of get there.
You brought up a lot of really great questions there, David, with some of the things that you look at from the beginning that can affect the way something is accounted for. Or from a tax perspective, when you get your tax advisor in there on the early end, it opens up the door to more opportunity. I mean, you mentioned like the sales agreement. Could it be a prepaid forward or something like that? The way that something is worded can impact the tax consequences. The way your agreement is worded can impact the result. And so to have someone in there on the early end, and you think about some of the areas that you deal with when you start having tokens, compensation. How many are trying to give their founders or executives tokens through compensation? Or there are different ways you can do that, and each one has a slightly different tax consequence. And ways that you can try to minimize, I would say, the tax impact of some of those distributions. And you mentioned like getting your information from Facebook. I would be careful of the information you read out there. It's so interesting to read some of the blogs posts and things that are out there on. I just sometimes laugh inside, and I just say I hope people don't really follow that advice, because it's not going to put them in a good place. I mean, one example is there was a number of months back, there was this craze about foundations and people setting up foundations to do their ICOs. And I even saw a blog post from a company that said that this is what they're planning on doing, where I knew they were thinking about that, but somehow I think the message got mixed up with whoever did the post, because they were not ready to have a foundation. It's very hard in the U.S. like to qualify for a foundation and to do a launch out of one. I mean, you basically have to have a social good. There aren't many that really, even though we all think, blockchain.
But blockchain's going to fix the world.
Blockchain is a social good, right? It's going to fix the world, but the way the U.S. law sees that is a little different, and so some of that stuff is a lot harder than you might think when you just read a blog post somewhere.
So I'm going to recuse myself from this conversation, but this question is going to be around jurisdiction. And, I see a lot of jurisdictional arbitrage happening right now. I can say like Bermuda, we've had, Binance is in more than one country. Bermuda is one of the countries. It's also in Malta. It's in Taiwan. So you're seeing these companies that are really decentralized. What is kind of the current thinking around jurisdiction? Where's not the best place to go, but what makes sense as you start planning?
So I think we should split this up into two sections. Okay. First, it's going to be the tax section, then it's going to be the legal section. Okay. So do you want to go first with the tax section?
Tax.
I can go first from tax, sure.
Move to Puerto Rico.
I'll just say number one is that tax always follows the business. Okay, you never go anywhere just for tax reasons, because if you do, you're going to end up in trouble. And Bermuda, I mentioned this earlier, Bermuda is one of the great places. I've had some clients go to Bermuda, But they've done it right, and that they've gone and they've put some operations there. They've constructed their business in a way that they're getting their IP, and they're making sure that that's actually a part of their international expansion from the U.S. So that's an important part of tax. I mean, that's the number one thing, is that tax doesn't drive that decision. But and also mention that Bermuda has great tax rates. There are other Caribbean islands and the Cayman Islands that have 0% tax. It's been a popular place for ICOs. Another consideration is that the facts have changed post-tax reform. So 6 months ago, the landscape definitely changed, where before someone, even a US-based company, if they issued the right type of token, they moved everything in the right way offshore, and they're moving internationally, they could have a token sale and not be taxed on that in the US if they did it right. But now that's it is impossible because of tax reform. You now have the GILTI regime, and anything that happens offshore in the US is taxed. But there are definitely places that are still make it a better place, and a better. If you launch in the U.S., you're full U.S. rates, but GILTI regime, as long as you fit the right construct, is essentially half of that.
I'll just be very brief since we're coming up on time for Q&A. On the legal side, I won't do a global whirlwind, but let me just mention that with regard to legality, whether crypto as a security, or a specific one, isn't the only consideration you should be looking at, right? There are other regulators that come into play. The CFTC, for instance, if it's a commodity, right? Or if you're a cryptocurrency fund, then the SEC's, if you're a registered investment advisor, then the SEC's custody rule requires you to hold all funds and securities at a qualified custodian. Well, is cryptocurrency a fund or a security? Well, what's a qualified custodian in this space? So there are outfits that are in the process of applying for instance, a broker-dealer certification or status with FINRA and the SEC. So all eyes are on shops like that. There are trust companies that are trying to get that classification. So anyway, there are a number of regulatory frameworks that you need to keep your eye on.
Absolutely. So what I've been advising clients to do has changed dramatically over the past 7 months. I know initially it started out with, yes, we can have your company based in the US, and then we could have the ICO somewhere else, have the issuer in an offshore account, so you're able to issue those tokens and then get the funds from a third provider. So I was able to travel to Singapore, I was able to go to other places in Asia, and then travel to Europe to try to find, everyone's trying to find the best place. I just wanted to know the characteristics and the differentiators between each one. So that changed too. In January, it was Singapore. That was the best place to go because they just took that new reign away from Switzerland, which said they were going to make a regulatory sandbox and let everyone play inside. Quickly in the middle of January, that regulatory sandbox changed, and they were able to add more regulations, which made having your ICOs and having your blockchain company hosted in Switzerland tougher. So people started moving to Singapore. I know a month and a half ago, I just got notice from one of my friends, she's a corporate secretary in Singapore, that the Singaporean government and then the couple banks that were actually allowing blockchain companies to host their money in there, they were excuse me, I'm getting excited, right? They were blacklisting these corporate secretaries. So the ones who were just quickly charging between $50,000 and $200,000 to have an ICO, were just getting in all this money from all over the world and starting these bank accounts. They were getting blacklisted from not only starting bank accounts, but also working with certain levels of the government because they knew that the government knew that those corporate secretaries weren't auditing their clients correctly. So when you start having money that's getting nervous that there's money laundering or there's fraud involved, that's when you start closing it off. So recently, Gibraltar started popping up. Malta started popping up as usual. Switzerland, I think, is trying to get their feet back on the ground, but I don't know. I still have hope for Singapore, but at the same time, right now, it's not the most friendly towards ICOs. But where you guys need to start looking at, when I say guys, you ladies and gentlemen need to start looking at, is looking for places that are going to have direct connections with national banks. Because that's going to be the next step, and that's going to be a big differentiator. If a blockchain company can bank seamlessly and without a lot of lead time or lag time.
Yeah, and I think, speaking not speaking for Bermuda, but speaking as somebody who's really, really tight with a lot of the regulators, you know, they look at this space and say, look, we want to be in it, but we have to be incredibly cautious how we go into this. And everybody's playing this game of like, well, we're going to put in tougher and tougher regulations because we only want the best. We only want the cream. And unfortunately, there's a real tough balance there, which is, you know, if you do make it a little too hard, you're just actually going to just squeeze everybody out, and they're just going to go to the least, you know, the one that has the least amount of friction in operating and compliance. So, you know, everybody's trying to find, we call it that light but fair regulatory environment. It's a really, really hard balance, and I think you're going to see a lot of ebbing and flowing between different jurisdictions. But ultimately, you know, what we'd like to see is harmonization across a lot of the different jurisdictions in terms of how we treat, how we view, and also the, you know, what are the penalties? You know, there's another side to this, which is like, you know, if you want to really protect a jurisdiction, if you really want to be in the right place, look at the penalties of like, do you go to jail if you break the law? You know, I probably want to put my business somewhere where there's a severe penalty that I'm not going to make those mistakes. But if somebody comes in and does that, I don't want to be in a jurisdiction that is known for doing bad things, or people that go in that jurisdiction do bad things. So, you know, there's a couple of reasons why you want to be in a very well-regulated jurisdiction.
And, you know, and that's not, I want to just make sure, that doesn't mean the U.S. is not a viable option. You know, I was just over in D.C. last month, and I had a nice one-on-one with an SEC commissioner, and she was legitimately wondering, what does a utility token look like? What is the framework? Because a lot of what's been coming across their desk has been filled with fraud, filled with bait and switches or snatch and grabs, and they just want to know, what does it look like? They don't want to hinder the playing field. They just want to make sure it's fair. So it'll take a long time to get there, though.
Okay, so we're going to do about 10 minutes of Q&A. We'll answer any questions. So, all right, first hand.
Question. We might have to handle that one off. But just so there, I mean, if you're just I'll give you some considerations you have to be thinking about, right? Because if you're an individual and you're putting money into a business, number one, if you're going to put crypto into that business, there's, you know, depending on the way you structure it up, whether it's a partnership or corporation, is going to change the way that you're taxed, because you could potentially be taxed right away on that event when you put that crypto into that business. And so you need to think about that. And internationally, you know, some people are saying, well, I'm just going to put my business, I'm going to incorporate in Puerto Rico or somewhere else. But if the cap table, or you as an individual owning that business is in the U.S., you're still going to get taxed the same way as if that business were in the U.S. You're just making it a lot harder on yourself and actually might get taxed more. So there's definitely some important considerations around that. And I mean, happy to talk about your specific facts after if you'd like.
So I could talk about what I did on a one-to-one level. So just to keep my business clean, whenever I got paid in cryptocurrencies, I automatically converted it all to cash. So what I did was I kept all of those numbers recorded too. So I would take the cost of my services were $5,000. So I received $5,000 in Ethereum. Then I would go through a series of exchanges to finally get it to cash. And I minimized it so I only lose 2.5% at that time. So when I finally change it to cash, that's when I write down how much cash I received, how much I lost from the conversions, and this is all processed out too, and then how much money I actually recognized. So I'm able to still add that to my gross income, but still write off as a business expense the losses I had from conversion to fiat. Is that correct? I hope.
Sounded pretty good.
And you probably also want to make sure you have, if it's a business, that your wallet that you're doing that in is somehow deemed to be your business wallet as opposed to a personal wallet. Again, there's like separations and all those sort of things that you should be
Really
taking.
key. It can be hard, like the specific ID and everything. You need to With some best practices around making sure that you can actually specific ID that, and it's setting up different wallets. It's doing things that where you're absolutely sure, and you can prove to the IRS that's the crypto that you had that was transferred.
All right, knocking it out of the park here. All right.
So I'd say typically Delaware is your best bet for certain situations, especially if you want a very well-established series of case law. I know people have been talking about Wyoming lately. I would not advise a client to start their business in Wyoming, even if there are regulations being built around it. It depends on the business. I know I'm working with a couple clients who are planning on having an ICO, but do not have a blockchain-based business. And because of that fact, and it's a utility token, and because of that fact, I'm advising them to incorporate right here in the States.
And there are some states that are really trying to reach into some of these ICOs. Like we see Washington being pretty aggressive. And even just your basic decision on just what the tax rates are. Because if you have the type of token that would be taxed, a lot of states are imposing their state tax on that as well.
Are you from Wyoming? No. Okay, just checking. Okay.
I just don't know Wyoming law well enough, and I don't know how well established. Obviously Wyoming is very committed to the regulations that they put in place, and it seems as if they're going to continue with that stance. But just a lot of the other regulations around it, they don't have well-established case law when it comes to. They don't have as established case law as Delaware and as California do right now in this moment. So the advantageous regulations that they do have, I don't know if that trumps all of the other benefits that you would have by traditionally incorporating.
Yeah.
Yes. Yes, and it is always better to try to plan before you do your ICO when it comes to some of those compensation plans with tokens.
Actually, that's a good question. Do you actually create an option pool in your ICO? Like, should you actually say, this is my option pool, same as you would in shares, right? Like you said, this is our employee option pool.
Yeah, you can create options with tokens. The thing is with options, the way an option works, so if you grant a token to someone, and whenever they exercise that option, that's the value of the token at that point is the value at which they're taxed. And so there are other ways to maybe before your ICO, you could potentially get a valuation on the token before you fully built out your system and give them tokens at that point, and that can help minimize the tax. But after you've done your ICO, it does get a lot harder because that token has a value on an exchange, and when you give that token to someone, that is compensation for the value of the token at the time at which you give it to them.
And I have something to add too. If you have an ICO and you're planning on giving parts of those tokens to your employees, that better been included in the white paper, because that white paper that's out there, that's an investment that's a contract between you and every single person who started purchasing your tokens. So if you start allocating other percentages of those tokens elsewhere that was not identified in your white paper, then you have lawsuits by each of those individual purchasers of every single bit of a token prior to that point. Which leads me to one more thing. When it comes to white papers, each of those are contracts. So you can't just keep on revising them one week after another, because they're able to just take your first white paper, see the promises that you made on that, and then sue you because those promises didn't come to fruition.
I'll just say that from the accounting side, that presents certain challenges, right? So if you're the issuer of the token, how do you book that, that event, right? What do you owe the participants, right? Is it defined in the white paper? Is it, what is it? So anyway, a lot of
it's amazing in a Q&A session we've actually created more questions than answers. We're doing a really good job here. Yeah. Okay. What last question?
So if it's a security token, so a security token, it could be different for tax. It could either be a piece of property by tax law, or if it has certain if it has equity-only characteristics, then it could potentially be not taxed because it is an equity token for tax purposes. Yeah, but even when you have a warrant, I mean, it still depends on the characteristics of that token, because that token could have utility, and that could compromise your equity treatment potentially.
And when you are still listing it as a security, you need to make sure that you have proper KYC and AML providers. And I'm not talking about the best ones in this current ecosystem. I'm talking the ones that still hit every single US requirement as well.
With that, I want to thank everybody for joining us. Hope this was the most interesting tax advisory